MoneySense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.
A very good morning and warm welcome to MoneySense. Your hosts this morning are our regulars Christoph Barnett, Neville Hicks and myself, Simon Cordery.
Good morning.
Good morning.
Good morning. I'm delighted to be joined in the studio this morning by Gary Dombowski. Gary is the CEO of Knighthead Annuity and Life Insurance Company, which is a company operating here in the Cayman Islands, and he's here to discuss a crucial component of the investment industry, that of annuities. Gary, thank you very much for joining us this morning and welcome to MoneySense.
Oh, thank you. It's great to be here.
Well, it's our pleasure to have you. So, I mentioned the word annuity, and a lot of people will hear that word and it's got a lot of vowels with a couple of consonants in it and not have the slightest idea what that really means. And in preparation for our show, there may have been one or two of our hosts who had a slightly less than stellar understanding ourselves of what an annuity is. So do you want to just set the scene as to what exactly an annuity is? And then we can talk a little bit about why annuities developed, what they're about, that sort of thing. We want to try and understand a little bit about this industry.
Sure. Well, thank you very much for giving me the opportunity to do that this morning, guys. So an annuity in its simplest form is really a savings product. It's issued by an insurance company, and it's designed to help a client accumulate money or a pool of assets for their long-term purposes. So a simple example would be someone who has $50,000. They invest in an annuity contract for, say, a 5-year period at a time and receive a guaranteed interest rate. They keep renewing that contract until, say, they're 60 years old. And then at their option, they have the ability to convert their accumulated assets into a regular stream of income. And that regular stream of income can be 10 years, 20 years, even for their lifetime. So during the accumulation phase, it's really a combination of insurance and investment because there are certain insurance benefits that can be attached to these policies, which include like a death benefit if the annuitant should happen to pass away. But ultimately, they are investment-oriented, and they're one of the few ways in which someone can essentially guarantee a stream of income that they cannot outlive.
Okay, so I want to pick up on that one particular word you used there. You used the word guaranteed. Whenever I hear the word guaranteed in the investment context, I quiver a little bit because you think, oh, nothing can be guaranteed. Right. But what you're saying is you can invest rather like if I put money in a bank for 5 years on a term deposit, you're guaranteeing a fixed rate of return over those 5 years. Is that what you're saying?
That's what I'm saying. So guaranteed, like whether it's a bank or whether it's an insurance company, the guarantee is only as good as the insurance company or the financial institution that guarantees to pay you that interest rate. But you are essentially not taking any, market risk if you go for the guaranteed option. Now, there's other forms of annuities where the returns that you receive can be linked to the performance of mutual funds or even the stock market indices themselves. So there's various forms of ways to accumulate money. Some have market risk attached to them, and some provide you a guaranteed interest rate.
Well, let's focus in on that. So the two different types. The first of which, which is the guaranteed, is a fixed annuity.
That's correct.
And the other then is called a
variable annuity.
Okay, so you've got a fixed annuity, which is rather like putting $100,000 in a bank for 5 years. You get a fixed rate of return of those over those 5 years, and then the money is yours.
That's correct. At the end of the 5-year period, while the options to convert to a payout annuity always exist, they're completely optional to the client. They're not forced to take that payout option. Sure. So essentially, someone can use this simply as an alternative to a bank CD product or even a bond.
So let's talk about that. If I were to take a pool of money that I've got and invest it in for 5 years with a bank, I go down the street and I find one of the local banks and I say, what term deposit rate can you offer me for 5 years? And then I say, well, what are my other options? I can go invest it in the stock market, I can go and invest it in the bond market, I can invest it in all sorts of weird and wonderful areas. Or now I'm hearing I can go and invest it in an annuity. What sort of rate of return would I be able to get on an annuity, perhaps? And then we can talk about what might be able to be achieved elsewhere.
Sure. Well, it really varies by carrier, of course, and we're not the only ones issuing annuities in the Cayman Islands or elsewhere. But essentially, there are some lockups attached to these products. So when you invest in an annuity, you really need to make certain that you can always get at your money, but it shouldn't be considered a ready source of cash for you. So you have to be prepared to invest for in our case, we go for as short a duration as 3 years. So on a 3-year product right now, we're paying approximately 2.3%. I'm sorry. On the 5-year, we're paying 2.7%.
Okay,
and that's per year on your on your capital.
That's right.
But you don't get that 2.3 or 2.5% in cash each year. It accumulates as part of the annuity, does it?
That's correct. Now you do have most annuity contracts do provide you some access to your money. So in our products, and this would be standard, you do have the option to receive 10% of the amount of the annuity annually without any fees or expenses attached to it.
Okay, so I now understand a little bit about what an annuity is. I understand a little bit about what the rates of return are. Christoph, can you perhaps help us out and say, okay, if I were to go and say buy a 3-year government bond or 3-year bank deposit, what sort of rates might I be getting in that? And then we can sort of have a discussion about, well, why are those rates different? Why does one pay higher or lower than the other? So where would we sit on that?
So government 3-year rates obviously depends on the currency, but let's stay with U.S. dollars. They would be lower. I believe 3-year is somewhere 1.25 to 1.5, depending on the government. 1.5% a year, so less than what was just quoted as a return on the annuity. Corporate bonds would pay a little bit more, maybe over 2%, a little bit closer to what was just mentioned.
And then what are we seeing bank deposit? Bank deposits seem to be almost close to zero as far out as you go, right? It may be 0.5%, 1%, something like that, perhaps.
If we're optimistic, there are some banks that want the fixed deposits and can actually pay as high as 1.5%, depending on the amount that you bring. But otherwise, yes. Yeah, you have to be kind of concerned. If the bank is paying too much, maybe it's too good to be true. And
okay, so that's an interesting
point. Might be some risk.
Because someone may say, okay, I'm hearing about this annuity product. It seems to be paying more than I might get elsewhere. Well, and you hit a nail on the head potentially, Christoph. Is that too good to be true? In other words, why can a product guarantee me a rate of return which is better than I might be able to get in most other opportunities? And so why is that then, Gary?
Well, we're guaranteed to have the money for a 3, 5, or 7-year period. So that allows us to construct a general account portfolio to support that. Can be comprised of other things other than just, U.S. Treasury bills. So we can invest in a range of rated securities that, can be from BBB plus all the way up to A minus or A. And again, we can match that portfolio to the duration of our liability. So knowing that we have the money, for that 3, 5, or 7 or 10-year period allows us to do some things with the money that we would not, you can't do if you're a bank and someone can come in and withdraw their term deposit without any surrender fees or other fees attached to that withdrawal.
And I think just adding to that, I think it probably gives you as the insurance company the ability to obviously pool various people's annuity together and look at other options to give you kind of a risk profile. Spread the risk, exactly. So
what I'm hearing then is you take people's money, you invest it yourselves in things that perhaps the ordinary person may struggle to have access to. And by doing that, you're able to get a slightly higher rate of return, which means you can offer that rate of return to the collective people who buy the annuities.
That's correct. And that would be the same for every insurance company.
But there is a risk that you might go and invest those funds and they go down. Markets have this habit of, unfortunately, going down when we least want them to. So how does somebody know, or what reassurance do they have, that when they buy this annuity, and as you say, there are many annuities, rather like there are many banks out there, and one shouldn't be flippant about depositing money with a bank simply because it's got the word bank in its title. What should one be looking for when one chooses an annuity to have confidence that they're going to have some
or the
certainty?
Guarantee is good.
Well, the guarantee is good, yeah.
Yeah, just like any...
more succinctly put.
So what you have to do is validate the financial strength of that entity, whether it's a bank, insurance company, or any other institution that is guaranteeing to pay you something under a contract. So the best way for the average person to do that is look for the validation that comes from an independent rating agency that really does the research and analysis that you as an ordinary buyer can't do. So in our case, we have an investment grade rating from AM Best, the AM Best analysts.
And just want to interrupt you, because a lot of people who are listening won't have the slightest idea who AM Best are.
Right.
Who are AM Best? What are they?
That's a good question. So AM Best is a independent rating agency that assesses the financial strength of insurance companies. They've been around since 1889, and they focus largely on the insurance and reinsurance industry. And their mission is really to assess the ability of that entity to meet all its policyholder obligations when due.
Certainly. So
that's what AM Best does. Now, AM Best, as an example, it's a very, very rigorous process. The reports are available online, to anyone who wants to look at them. And in our case, AM Best came to the island. They met with the regulators. They did an assessment of everything from our risk management plan to our business continuity structure to, of course, our investment portfolio. So they really do a fantastic job. And I think, individuals that buy, any insurance, policy should really be looking for the financial strength that has been validated by an appropriate rating agency.
We have to take a very short break here, Gary, and after the break, I'm going to ask you a little bit more about annuities in relation to what to me is a hugely important topic here on the island, which is the pension industry. Because people who take a pension, when they get to pensionable age, then they come up against some challenges, and annuities can potentially solve that challenge. And we'll also talk a little bit more about analysing the strength of a annuity company. So we'll take a quick break and join us again after the break.
This is MoneySense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X. And now, more MoneySense.
Welcome back. In the second half of today's show, we are going to continue our conversation with Gary Dombowski about annuities and the annuity industry. Just before the break, Gary, we had touched on the analysis that one needs to do of choosing an annuity. Rather like when one puts money with a bank, one has to say, is this bank good for making this payment back to me in a couple of years? The same needs to be done with annuities. And you had touched on the fact that in order to do the analysis, there's a lot of work one would have to do. And that's why these rating agencies exist, AM Best, who go around and say, this is a reputable firm, this is a decent firm, we rate it this, that, or the other. That shouldn't, of course, mean that people shouldn't do their own extra homework. There were some troubles in the late 2000s with the rating agencies getting themselves into a little bit of trouble by overrating certain things. So I think you'd probably agree with me that people should still also familiarise themselves with the financials of the organisation they're doing business with, and presumably all annuity companies, you can get those financials fairly easily. They're on websites and such like. Is that something that people can get access to?
That's correct. People should really see you can always ask for the financial statements of the firm. You want to make certain the firm is profitable, that it has sufficient capital. In our case, when we did our capital raise, we raised $230 million to capitalize the company. And, one of the things that you want to look at, it's a bit technical, but is really look at the amount of capital they have relative to their policyholder liabilities. Most banks, and people might be surprised to hear, hold about 7 cents of capital for every dollar of liabilities they have. And the insurance industry in general is around 12. We're about 50 cents. So in any case, looking at the financial statements, if a company that you invest with, is not prepared to give you their financial statements, you really probably should think twice about investing with them.
Yeah, and I just reiterate the point. I totally agree with you that using independent experts, the AM Bests, the S&Ps, the Moody's, the Fitches of the world is a vital part of the exercise. But individuals should never rely exclusively on such ratings when making a decision. Is this a reliable? There's always reasons to do additional homework. Just check things out for yourself, because when things go wrong, having relied on someone else is not an excuse to say, well, I want my money back. That doesn't happen like that, right? That's so important. So I wanted to move the conversation on annuities into the pension sphere. But I want to also, but perhaps before we do that, I wanted just to get your analysis or understanding as to why did annuities start, and what's the background there? Why did annuities come into being? Because I think that will help in trying to understand why the pension industry relates to the annuity industry so well.
Sure. Well, annuities really started, I mean, believe it or not, they go back to the Roman period when soldiers returning from battle were granted an annual stipend that would carry them through their lifetime. And really the needs really haven't changed from that time, where, individuals today may be looking for annuities that provide, again, a regular stream of income that, for a certain period of time or perhaps even their lifetime. So that's really one of the main purposes of annuities. It can serve as an accumulation vehicle, but also the payout option is very important.
And so that actually hits the proverbial nail on the head here, which is it's about a lifetime payout. Roman times, maybe one's life was slightly shorter because of battles that may have been indulged in, but and one hopes there won't be pitchfork battles on the streets of Grand Cayman. But when one has a pension, and there's been a lot of discussion about the pension industry. Last year we changed the pension law a little bit, and then at the moment there's a consultation period about the investment regulations with respect to the pension industry, and there is some good debate going on between the National Pensions Office, the pension superintendent, and interested players in the industry. But something that hasn't often been talked about, and I think needs to be talked about a lot more, is the implication for those people who have a pension, may have had it now for about 20 years, or people who are starting out their pension, when they get to pensionable age, so when they get to the age of 60 or 65, then they're faced with until recently, quite an unpalatable set of choices. One of the choices was, I think I'm right in saying it's about, you can get a payment monthly of about $1,000. Mm-hmm. Now, I challenge anybody on this island to live on $1,000 a month. The other option is you can buy an annuity. But of course, people hadn't been familiar with what annuities are. So what as someone who's accumulated $250, $500, whatever the amount of thousands of dollars they might have accumulated, what are they going to be able to do once they reach pensionable age? And what does the annuity deliver for them? Right.
So the annuity, I think there's many ways, I guess at a high level, many ways to accumulate money. But there's very few ways to decumulate it, meaning how do I actually
I don't know. I spend money quite easily on this island.
How do I take the money out over so that
sensibly.
Right, that I'm guaranteed a certain amount each month. And the annuity can do that.
Because the pension law prohibits you from taking your $500,000 or $100,000.
You can't take it as a lump sum.
You can't do that. So you have to either take this $1,000 a month or you have to buy an annuity. And so the education about annuities and what they do is important. So explain, so where does that go?
Even when you take the $1,000 a month, remember what you have left in the pension is still subject to market risk. So you've worked hard, you've got $100,000 in your pension, or say $200,000. You certainly have the option today to take $100,000 and enter into the payout annuity for your lifetime. And under the current rules, it has to be a lifetime option. Mm-hmm. I would like to see the rules change that you could take that out for, say, 20 years, because if something happens where you took your pension money out, you bought an annuity contract with the entire amount, you and your wife are in some horrible accident, essentially the insurance company retains the money in that circumstance.
And isn't required to pay it out because your lifetime is done.
That's right. But so now on a certain annuity, you would be guaranteed, you or your beneficiaries would be guaranteed receive, 20 or 30 years of payment, in all cases.
Okay, I was going to say, so in the case of someone who has $200,000 and they take and allocate $100,000 of that $200,000 to an annuity, they would then receive their monthly $1,000 from their regular pension payment. That's right. Plus whatever the annuity was paying out on a monthly basis for that 100. So you kind of be getting double payment.
Or you could put 100%
right?
into an annuity.
Right.
Or you could put 100%. But in the case of splitting it, let's say.
So what you've done with the annuity is not simply, found a nice orderly way to take the money out. You've actually taken the market risk out of your pension assets, because the insurance company, when we do this, we would look at what the prevailing interest rates are.
Mm-hmm.
We would embed an investment return in that payout annuity itself, and then we would amortize those payments over a 10, 20, or 30 year
You've
period.
used a lot of big words there, amortize and such like. So I'm going to go back to first principles. I've got a pool of $250,000 that I'm 65, and I may look at, but I'm not there yet. So I'm a hypothetical person, but a $250,000 pool of money. If I were to take the $1,000 a month, that's $12,000. It's going to take me 20 years, and I'll have nothing left. So if I live for 23 or 24 years, I'll have no pension. Albeit I won't be able to live on $1,000 a month anyway, but leave that to one side. With an annuity, that's not quite how things work, is it? You're getting a higher rate of return because you're taking some risk as an insurance company behind the scenes.
That's correct.
So perhaps help us understand how that maths works a little bit. And we might get Christoph on his calculator putting this into context for us.
That's right. So think of it almost like a reverse mortgage. You've given us $200,000. We have an interest rate that we look at what the markets we can actually provide or embed in those calculations. And we take your premium that you've given us with the returns that we're going to earn over 20 or 30 or your lifetime or your expected lifetime, and we add that and then simply spread that out over the 20 or 30 year payment period. And
it doesn't matter if you live for 30 or 40 more years, you still are getting that money.
That's correct. That's on the lifetime income option.
And is that adjusted for inflation, or how does that work?
No, it's not.
It's a fixed amount. It's
a fixed amount. And it is, and it's important on these things is that they, once you make the decision to buy a lifetime annuity, you really can't, it's not something you can change your mind on. That is a final decision.
Sure.
Yeah.
So someone with $250,000, I think you had said earlier to me that they would be getting perhaps about 3.5%.
That's correct.
Return each year and so in other words, you divide or multiply $250,000 by 3,500. That's the annual income that is generated, and then you as a company estimate the life of about 20 years or 25 years, and then you divide that 250 over those 25 years. So you're going to get at least $10,000, 250 divided by 25 years. That's at least $10,000 plus the rate of return on that. So Christoph typing furiously, I can see on his calculator. What are we talking here in numbers?
This is too much for my calculator.
Well, I think the important thing is that it's another option, and you're creating You're creating a different return stream and taking on a different risk and really allowing to draw more during your lifetime. Yeah. I think what's important.
It's about $17,000. Right. So if you've got a pool of $250,000, an annuity is going to pay you about $17,000. The only other option you have is to take this $1,000 a month. And remember, if you've got a pool of $400,000 or $500,000, you've still only got $1,000 a month. It doesn't increase, whereas the annuity has a higher options.
And thank you, Simon. And importantly, remember that the pool of which is generating your $1,000 a month is still subject to market risk.
Right.
So it can go down. You may not be able to get $1,000.
It could go up though too.
It could go up.
Yeah.
That doesn't help you at all because you can only still get this $1,000 a month under the current regulations.
That's a good point.
Yeah.
So we have about 1 minute left of conversation, and rather than getting completely confusing myself with lots of numbers, just talk to us a little bit about how annuities are regulated. So on Ireland, so SEMA regulates them, right?
Yeah, this is important because annuities are issued by insurance companies. They are subject to insurance regulation. So SEMA, as an example, takes a look at how you invest your assets. What ability do you have to meet all your commitments when they're due? You're subject to all the good governance that is typically required by a regulated financial institution. So I think that's an important element relative to buy an individual bond from a single issuer.
Yeah.
Here you actually have a regulated issuer.
And where does one buy an annuity from, basically?
There's the question. Because
I
would imagine...
it's very simple to do. There's an application form. I don't know of all the providers in the Cayman Islands. I know that we are one, Knighthead Annuity and Life. We're in Cayman Bay. And I know that Sagicor is also a provider. And so persons should always do their homework, do a comparisons of if you're looking for a payout among the various issuers.
Okay. Now, we are very close to the end of the show. Neville, I know you want to say a couple of words about the upcoming CFA Investment Forum. So can if I just want to interrupt the conversation to give you the mic for that.
Yeah, thank you. Just an update on that. We've got the CFA, the annual CFA Investment Forum coming up October 13th at the Ritz-Carlton. This is going to be a half-day event. We've got some fabulous speakers coming down kind of from all over the world. So I strongly recommend our listeners to go to the website. It's www.caymaninvestmentforum.com. Have a look at what's going on, and please register. It's going to be a great afternoon.
Maybe we can get Gary's company to sponsor, and people can come up and ask some questions.
I thought this was a free event this morning, Simon.
No such thing as a free radio show interview. So Gary, look, I'm awfully sorry, but our time is up. The 30 minutes goes incredibly quickly. So thank you sincerely for spending time with us this morning.
Thank you, and thank you to Cayman. Have a good day.
Thank you. So as a final note before we leave, I wish to just thank every one of our listeners and remind you that today's show will be available as a podcast on the CFA Society Cayman Islands webpage. I encourage you, if you have questions, to email us at moneysense@candw.ky, or you can tweet us. I think that's the right verb, isn't it? At MoneySense Radio. Be sure to follow us on there. Post any questions. If you want more information about any of our shows, we'll always respond to any tweets on there. With that, thank you once again. Goodbye. And please do join us again in 2 weeks' time on MoneySense.
MoneySense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.